You may remember we discussed about premiums for options, and there we discuss premium consists of two parts: time value and the intrinsic value. Okay. Can someone tell me what's the intrinsic value? If you need. Of this option contract. It's a 1 month call option, spot price 56, strike price is 60. What is the intrinsic value? Zero. Yes. Why?
We do not exercise option.
Yes. Basically, call option has an intrinsic value, positive intrinsic value when spot price is higher than the strike price. Then only you exercise your buyer would exercise buyer's right. This is the exercise price. This is the spot price. Then only you have a positive intrinsic value. But in this case, spot price is somewhere here. Then you don't exercise your option because you can buy at the market price at a cheaper price than the agreed strike price. But you don't have any negative cash flow here. It's just zero. So therefore intrinsic value is zero. Now if the premium for this option is say 10. What's the time value? Sorry? 10. Why? Intrinsic value is 0. That's true. Premium is 10. Then why time value equals to 0? It's because premium equals to time value plus intrinsic value. So when this goes to 0, premium equals to time value. So therefore time value equals 10. So that's basically the summary what we discussed last week towards the later part of the session. Okay, what would happen if it is a put option instead of a call option? If it is a put option, what is the intrinsic value?
Okay.
Sorry?
Oh,
4. Why? In a put option, you exercise your right when the spot price is lower than the strike price. That means in a put option, what is the right that you get?
right to sell.
Right to sell. So you can sell at the market price, at higher price when the market you can sell it at the strike price when it is higher than the market price. So that difference is your intrinsic value. It's positive. If the spot price is above the strike price, then you don't sell it at the strike price, you sell it at the market price. There's no intrinsic value. Intrinsic value is 0. But in this case, spot is less than strike. The difference is the intrinsic value. Okay, premium is 10. What is the time value?
6.
Time value is 6. Why? Time value equals premium minus intrinsic value. Premium is 10, intrinsic value is 4, so the time value is 6. Okay, now intrinsic value, it's very clear, easy to get it, but time value, it's not easy to get it. We'll discuss how this value changes with different variables. Generally, we discuss about the premium, how premium changes with some other variables. What are the variables that we have already discussed that will have an impact on the premium? We discuss about
Right, right.
strike price. But indeed, yes, it is a strike price, and you can say, oh, the spot price, both, or the, but what matters is the difference, whether strike is above the spot or whether strike is below the spot. That depends whether it's a call option or a put option. So we are going to discuss these things today. What are the determinants of the premium other than strike price? Time to expiry. But we discussed slightly this one, time to expiry. With the long-term maturities of an option, what would happen to the price? Then price of the underlying assets, as I mentioned, this is related to strike as well. This is indeed the difference between strike and X. This is a relative thing. Then the volatility of the underlying asset price. Then other factors such as interest rates and dividends. We'll discuss very briefly how these things will have an impact on the premium. What are the impacts of these variables? So we discuss at the very beginning time to maturity. When the time increases, so time to maturity increases, there's more uncertainty. So therefore, high price, because the risk is high for the seller. So therefore, he needs some higher compensation. So the option will have a, when the option have the more time to maturity, then it will have a more time value than a shorter dated expiry with the same strike. Remember, we cannot compare two different options with two different strikes and maturities and things like. Whenever we discuss about one variable, we assume all others are fixed and same. So when we discuss about time to expiry, we assume strike and the volatility and these factors remain same. So the basic is longer the maturity, higher the time value. But what would happen when time reduces? Say initially 3-month option, initially 3-month, then there's a time value. What would happen with the time? Say after 1 month, what would happen? Since now, assuming all others remain same again, now the maturity is low. So therefore, time value goes down. We call it erosion of time value or time decay. When it gets closer to the maturity, time value decreases. Therefore, basically, value of the option decreases. The speed of erosion increase when it gets very closer to the expiry. During first month, maybe it gradually decreases maybe up to 2 months, but say within this last month period, it may decrease in a rapid manner, but again very close to the maturity, it decreases drastically. It is shown in this graph. So even though this says time to expiry, remember at this time it is the longest time to expiry, or you can say this is time, then this is the inception date. That means where you start the option. So at that time, time value is high, but when it comes to expiry, on the expiry date, time value is 0. You can see there's a drastic drop towards the expiry. This is how time value changes of an option. Longer the maturity, higher the time value. With maturity reaches, time value goes down. Very close to expiry, time value goes down in a rapid way. So if you buy an option, there's a value. You paid the premium and you have some value. What would happen if you hold it until maturity? Value of that option may go down because of this erosion of time value. But because of other reasons, value may increases. However, time value decreases. So therefore, time value of the option works against the option buyer. Holder means option buyer, because time value erodes with the time. But then it work in favor of the writer or the seller of the option. He has already collected the premium. Now premium goes down, or the value of the option goes down. When the option value goes down, there's less chance to execute that by the buyer. So therefore time value works against the buyer and works in favor of the writer. Then the next variable we want to discuss the price of the underlying. So as I mentioned, what matters is the distance between the strike and the price of the underlying. You may remember we discussed about the strike. If strike is high, what would be the premium for a call option? Is it high or low? Strike is high. For a higher strike price, premium of a call option would increase or would be high or low. We discussed this last week.
So the chances of the actual price moving there might be low, so premium would be low, right?
Premium would be low. Yes. The answer and the explanation both are correct. Chances of getting to that is low, therefore the premium is low. So strike and premium has a negative inverse relationship between strike and call for a call option. Strike and premium has negative relationship or the inverse relationship for a call option, but it's for a put option. It would be other way. When the strike is high, put option will have a higher premium. So, but whenever we say that, we assume whenever here in the call option case, when we say strike is high, compared to what? Compared to the spot price. Here when we say strike is high, still compared to spot. So if the spot is here, strike is here, then for a call option, strike price is far away from the spot, so there will be less chance for the spot price to go up to here or beyond that. Therefore premium is low. But for a put option, it is already in the money. Strike is high compared to spot price, then it's already in the money. So option premium would be high. Assume for a put option, premium is the strike is here, but still it's very close to spot. There's a chance of exercising in the future. Price can go down this one, so therefore premium is high. But if the strike is somewhere here, then chance of spot price going below this strike price is low. Therefore put option premium would be low. So that's why I said that either the price of the underlying or the strike, it is the distance between those two matters. So whenever we say higher strike, that's compared to the spot. If you have a higher strike, the call premium would be low. If you have higher strike, put premium would be high. The reverse is true for that means for lower strike. For lower strike, call premium is high, put premium is low. So if we say high spot, then what would be the case? High spot, call premium, high or low. If the spot is high, like this, say we take x1, x2, which call option would have a higher premium? Option with strike x1 or option with strike x2? Option with strike x1 will have a high premium because have a low premium because there's only small difference between these two. But with x2 the difference is high, so therefore it will have a high premium. So higher the spot, higher the premium. But remember, this is a relative thing, relative to the strike price. So for a put, then for a put option, higher the strike, higher the spot, what would be the premium? High premium or the low premium? Higher the spot, that means the spot price is much higher than the strike price, so out of the money sort of thing, so therefore the premium is low. So that's the relationship between price of the underlying, strike, and the premium. So the relative difference between spot and strike matters for the premium. So we discuss what is in the money option. That means you have a positive intrinsic value, then we call it in the money. So when the option is in the money, there's a high chance that the option will be exercised. If the option is deep in the money, I explain you what is deep in the money. So that means it's far away from the strike. Spot price is far away from the strike, but in the money. Then during the remaining period, there's a less chance of coming it back to the closer to strike or other side, lower the strike or higher the strike, depending on the whether it's a call or a put option. That chance is very low. Going out of from in the money, deep in the money to out of the money option, moving into that way is chances are very low when the option is deep in the money.
So
Yes.
when this is backed by maybe say equity, right? And if any there's a dividend X date going with in between the like the period, the price can drastically change there, right? Or
Yes.
if there are any
Yes.
cooperative.
That's why we are going to discuss dividends.
Right.
But your understanding is correct. Yes. We'll discuss how dividends would matter for the option pricing. So here what I'm talking about, when the option is deep in the money, there's a less chance of coming back to the out of money state. So there's a high probability of exercise, and therefore less uncertainty. So therefore less time value. When it's deep, when it is deep in the money, less time value. If you can remember, I explain you this with these two examples. In one option, time value is only 2. In the other option, time value is 21. I explain what is the reason. Because in this one, intrinsic value is 68. That means it's sort of deep in the money option. So when the option is deep in the money, time value is low. The premium of the option drives by the intrinsic value. So the reversal is true when the option is out of the money, and especially when it is deep out of the money. Chances of coming back to a in the money state is, or at the money state, is very low. So therefore, again, uncertainty is low, less time value. So deep in the money, deep out of the money, in both cases, chances of getting back to the other state is very low, less uncertain. So therefore, less uncertainty, therefore less time value of time value. There's a less time value for both deep in the money options and the deep in the money, out of the money and in the money options. Clear? So then what does it imply? What about at the money options? If both in the money and out of the money options have less time value, at the money option, they should have the highest time value. Because that's the place where you don't know to which side would this move. Lot of uncertainty when the option is at the money. What does it mean at the money of option? What does it mean? Or when do you have a at the money option?
In the exercise, the spot price is
When the strike price equals to the spot price. So at this stage, we never know which way would this spot price move. Depending on the whether it's a call option or a put option, the direction will have an impact. Or this option would become a in the money option or a out of the money option. So the highest uncertainty is at the when the option is at the money. So therefore, time value is high. Any questions? So the next variable is volatility, volatility of the underlying asset. If the prices are volatile, that means going up and down very frequently by large amounts, then what would happen? Again, the uncertainty is high. If it is going in a one way, one direction, you know, okay, this is going to go up or going down, but it's going up and down very frequently at by high values, then you never know what would happen. So the uncertainty is high. When the uncertainty is high, the premium is high, and therefore the time value also high. Remember here, volatility we measure through the standard deviation. If volatility increases, premium increases. That's the relationship. High volatility, high premium. I didn't mention whether it's for a call option or a put option. Irrespective of whether it's a call or a put, when the volatility of the underlying asset is high, premium is high. So that means time value is high. So time value increases. That's the relationship between volatility and the time value. Volatility, you can measure that what is the volatility or the standard deviation of price in three different way. One is historic. You get historical price data maybe for a 1 year or a 5-year period and calculate the standard deviation. That is we call historical volatility. But when you price an option, what do you consider? Can you take the historical volatility? You can use it, but then you assume that historical volatility prevail in the future for the whatever the lifetime of the option. So on the other hand, you can have a forecast on the future volatility. You can forecast future volatility and use that to price the option. The third one is you can observe the market prices, put and call option prices in the market. Then you can back calculate what is the volatility used to price that option. That is called implied volatility. What is the volatility taken into account when the market price the options? That is called implied volatility. What is the volatility implied by the market prices? So all these are ways of measuring volatility, and when you do pricing or you do trade, you have to think about which one is to use depending on the trade or your intention. Then we'll move into the other factors. Interest rate. Interest rate, again, like strike price, behave differently for call options and put option. Call options, higher the interest rate, higher the premium. What is the reason? If you buy a call, what does it mean? Buy a call, what does it mean? You get a right to buy the underlying asset. Why do you buy that? You think price of the underlying asset will go up in the future, so you can get the advantage. If you assume that price of the underlying asset goes up, why don't you buy the underlying asset? You can buy the underlying asset without buying the call option. What is the difference? Outright purchase and buying a call option.
You don't have to pay the full amount and you have option at the end.
If you have to buy the underlying asset, you have to pay the full price today. You need capital to do that. But if you have to buy the option, you don't have to pay the full capital, only the premium. Not only that, if price goes down, in the event that you bought call option, you lose only the premium. But if you have bought the underlying asset, you may lose whatever the price difference between the price that you paid to buy and the current market price. So that is, yeah. So when the interest rates are high, investors will tend to buy call options. Why? They can save their capital and invest it at a higher interest rate. Say if the asset price is 100, current spot price is 100, and the premium is only 30. Today you need only 30 rupees to buy the call option. But if you want to buy the underlying asset, you need 100 rupees. So without buying the underlying paying 100 rupees, you can buy the call option by paying 30 rupees. You can save 70 rupees and invest this at a higher or whatever the prevailing market interest rate. But when the market interest rate are high, you get high interest income on that. So therefore people tend to go for the call option instead of buying the underlying asset. So when the demand for the call option increases, premium increases. So therefore call option and put interest rate, there's a positive relationship. The opposite happens when for a put option, because in the put option you get an option to sell in the future at the strike price. Then you why don't you sell it today? If you sell it today, if the price of the underlying asset goes down in the future, you can buy it back at the lower rate and realize that gain. When the interest rates are high, even you don't have to pay the premium if you sell the asset outright. Not only that, you save the premium. Not only that, you get that capital, sales proceeds. You can invest it at a higher rate. So therefore, put options, there's a negative relationship and the interest rate. When the interest rates are high, put option premiums are low. That is the relationship between option premium and the interest rate. That changes whether it's a call option or a put options. Dividends, as you quite correctly said, who received the dividend? Dividend is received by the shareholder. You just buy a call option, you don't get the dividend. It will go to the option seller because he is the one, assuming, who is holding the share. So therefore premium is low. That's how it works. And not only that, then the factors like this also matters. Currency of the premium payment. So that means there can be asset may be denominated in dollars, but the premium may have to pay it in some other currency. There can be instances like that. Say if it is especially for a foreign exchange trade, say euro-dollar exchange rate. Whether you pay the premium in euros or dollars, that also matters, because based on the views on the market and the prevailing interest rate in two different currencies, exchange rates and things like that. So therefore this will have an impact on the demand and supply again. There will be an impact on the premium. So these are the basic factors that I wanted to highlight, and the relationship between these factors and the premium. Any question? So this is the summary. So what we discussed so far is summarized here. What would happen with the spot price? If the spot price increases, premium call premium increases, put premium decreases. Time to expiry, both rise. Volatility rises, both call premium and put premium rises. Exercise price rises, opposite, call and rise. The options, interest rate, options on physical rises, premium put falls, but on futures, generally, there may not be a impact. Why? What's the reason for a what is the reason for options on futures not to have any impact through of the interest rates? Why is?
Because you are exercising, this is on a future, that means you don't have to pay the full price there either, right?
Even you buy the future, you don't have to pay the full price. Even you sell the future, you don't get the full price. Again, it's only a margin, almost like paying the premium or receiving the premium. So therefore, there's no impact on that. So therefore, premium of the options on futures remain unchanged, or there's no impact from the interest rate changes. So that's the best thing. Don't try to remember this relationship like this. If the price of the underlying or the spot price increases, call premium increases, and put premium falls. Don't try to remember. Try to remember the reason. Then you can derive this outcome. Any questions? Any questions, please? If you don't have any questions, we'll move into the next. So this is a very important relationship between put options and call options. We call it put call parity. This related to the arbitrage. In option market. So when you price an option, the premium on the call option and the premium of the put options, spot price and the strike price, there has to be a relationship, and you have to meet this equivalence. Otherwise, there will be an arbitrage opportunity. What does it mean? Call option premium minus the put option premium. Remember, this C is for the call premium, P is for the put premium. The difference should be equal to the spot price minus the strike price. So this relationship we call put call parity, but this is not the exact relationship when we discuss about put call parity. Just to start, we'll start with that this, and I'll show you later what is the exact relationship. So indeed this holds only at the expiry. So we don't want some, it's not that much useful maintaining this relationship on the expiry date, but we need it for any time during the lifetime. But the reason this is given, this relationship is true anytime for options on futures. For others, this is sold only on the expiry date, but for the options on futures, this holds all the time. That's why this is mentioned. So what does it mean? Call premium minus put premium should equal to strike minus spot price minus strike price. So if you see, this is confusing because we use X previously. You can replace that with X, or you can rearrange this like C plus K equals P plus S. So either way, in some books you may see put call parity relationship in this way. It doesn't matter, same thing. So this is an example. If the futures price is, so the thing is, when you know any three of these variables, if the market is perfect, that means no arbitrage, price fairly, then we should be able to get the price of or the value of the fourth variable. It should be, otherwise there's an arbitrage. So if the futures price is 100.95, the strike is 100, call option on the futures premium is 1.07, then we can calculate the option premium for the put option. The relationship is C minus P equals S minus K. We know C, we know S, we know K. What we have to find is P. So substitute the figures. C equals 1.07, call option premium. Futures price, that means this is S, is 100.95. Strike, that means K is 100. You substitute that, you will get premium, oh sorry, this should be P. Premium on the put option is 0.1. So make this correction, please. Sorry, this should be P. So if the put call parity arbitrage holds, premium on the put option should be 0.1. If it is not, then you go to the market and see what is the premium on the put option. If it is not 0.12, something else, then there's a arbitrage opportunity. We'll see how to explore that in a moment. This is another example. Futures price is 101.5. So what is this? This is S. Premium for call with a strike. So this is K. Premium is 12. This is C. What is the premium for a put with the same strike? Again, substitute the figures. You get P equals 20.5. So remember, you need to know only 3 of these variables. You need to know 3 variables, 3 values, and you can find the fourth one, whatever it is. Not only the put option price. If the put premium, strike and spot and strike is given, then you can calculate the call premium. If the call premium, put premium and spot is given, you can calculate the strike. Or call premium, put premium and strike is given, you can calculate the market spot price likewise. So that relationship should hold for futures contract at any time. Otherwise, there will be a arbitrage opportunity. So for option on futures, the underlying asset is the future itself, because we buy an option. Sorry, we buy an option to buy or sell the futures. The future value is the underlying is on a future date. So therefore, there's no cost of carry involved in that buying a future or selling a future. But if you do that on an underlying asset, there's a cost of carry. Whether you buy the underlying asset today or whether you buy the option today, then there's a difference. So therefore, to consider that, in the put call parity, so we have to discount the strike price using the interest rate. So therefore, the formula we have to make an adjustment to reflect that time value of the strike price, because that is a future value. It's not value today. So to reflect that, what we do, we discount the strike price with the interest rate for the remaining maturity of the option. Remaining maturity of the option. This T, as you remember how to calculate the present value, it should be in years, because you use the annual interest rate here. So this is the only difference from the previous equation. Instead of strike price, we use present value of the strike price. So this is the proper put call parity equation. Other than for futures, options on futures, for all other underlying assets, this relationship should hold at any time. The previous equation, this is valid for options on futures at any time, but for other underlying assets, this is valid only at the expiry. But this equation valid at any time. So we'll do an example here. Share price 600. That means spot price is 600. Put premium for the 500 strike. What is 500? What is 7? What is 500? This is the What is this 500? This is the strike. Okay, in our equation. What is this 7? It is the put premium. Now we need to know what is the time period. It's 3 months. So T should be equals to what? It should be in years. So we use 3 divided by 12. You can't use 3 as T because it should be in years. This is R. So then the question is, what would be the call premium for the same strike, 500 strike price? So this is in summary. Spot price is 600. Premium is 7. For the put option, premium is 7. Strike is 500. T is 0.25. 3 divided by 12. And interest rate is 6% per annum. So this is the put call parity equation. Substitute these figures here. Then you get this. C minus 7 equals 600 minus 500 divided by 1 plus 0.06 to the power 0.25. You solve this. You get this. C equals 114.2. There's another example. If shares in XY PLC currently trading at 410p, 410 pesos. So what is this? What is this? Shares currently trading at 410. What does it mean? This is the spot price. What is this? The premium for the 400p call option. Then what is this 400? That is the strike price. This 20 pence is the premium on the call option. This is only 2 months, so T equals 2 divided by 12, and the interest rate is 3%. So again, spot price is 410. Put premium is this should be C. Premium on the call option is 25. Strike is 400. Time is 2 divided by 12. R is, or the interest rate is 3%. So again, the put call parity is call premium minus put premium equals spot price minus present value of the strike. To substitute the figures, 25, call premium is 25, spot is 410. Okay, strike is 400 divided by the interest rate or the discount factor, multiplied by the discount factor, you get the present value. You solve it, you would get premium for the put option E should be 13.03. So that's how you use put call parity to decide whether there's an arbitrage opportunity or find out the correct price. As I mentioned, if these are not inconsistent or in line with the put call parity, then there is an arbitrage. If this relationship does not hold, there is an arbitrage. How to explore that? What does it mean? So again, can you remember in futures we had cash and carry and reverse cash and carry? Can you remember when do you do cash and carry to explore the arbitrage? When the futures price is overpriced than the model, then you sell the future, you buy the underlying asset, and to buy the underlying asset, you borrow funds, buy the asset and hold it until maturity. So on the maturity date, you deliver your underlying asset to the futures, you get the futures proceedings, settle the borrowing, there will be a difference. That is cash and carry. So likewise, in a put call parity, reversal and conversion are the two ways of exploring the arbitrage opportunity. If the call is relatively cheap, then buy the call, sell the put, and sell the future. So it is simple because we are using this one on futures transaction, not on the any other underlying transaction. We just discuss here on option on futures. Then it's easy to understand. Call is relatively cheap. What does it mean? You use the market put premium, market spot price, and the strike. You calculate a call premium according to this put call theory. Say it is C naught. If this C naught is higher than the call premium at the market, what does it mean? In the market, call option is cheap. Then what do you have to do? Go to the market, buy the call option. Then you have a risk. Once you buy the call, you have to pay the premium. And if the price of the underlying asset goes down, you will lose your premium. In the arbitrage, there shouldn't be any loss. If you do the arbitrage properly, it should be a definite gain. So to cover that risk, what do you do? Synthetically sell a call option. Sorry, yes, since you have already buy. So what do you do? Sell the put option and sell the future. Then you can cover your position. In the conversion, it is the other way around. When the put is relatively cheap, then you buy the put, sell the call, and buy the future. So opposite of this, sell the put, here sell the call, sell the future, here you buy the future. So that's how you hedge your explore the arbitrage opportunity in the market.
So why do you sell the future in the reversal part? Hello.
Yes. To cover your call option, because you have already bought the call option.
Okay.
Then what is your future obligation? You have bought the call option. You have bought the.
So you need to deliver when they call, right?
Yes. No, they are not calling you are the party
All
who
right. Yeah,
bought.
sorry. So yeah,
They,
I
they,
don't have an obligation, right? Okay.
yes, then what do you have to do? You have to sell the call in the market, no, synthetically, because you have already bought the call option.
Yeah.
What you have to do? You have to create another
Position.
transaction which is equal to selling the same call. That
Okay.
difference, buying price and the selling price, is your profit.
Uh-huh.
Okay. Okay. How to do that? I'll explain. So this is the put call parity equation. We can rearrange this. How? We can say C equals P plus S minus K. Correct? We can say call premium equals to the put premium plus spot price minus strike.
That's right. Yeah.
Okay. What does it mean? Call option is equal to put option plus long call equals to long put plus long underline minus future. Long put, long underline, short future. Minus future means you sell the future.
Yes.
So this is it. This is the long call.
Uh-huh.
But here you want short call. You have to sell the call because
Yeah.
you have already bought. So short call means you put minus signs here. Then this become minus, this become minus, this become plus. So you sell the put, you sell the future. Because sorry, earlier when I explained, I put the K as the future. No,
Yeah.
underline asset here is the future because we do it on the futures. It's an option on the future. So the underlying asset is the future.
Okay.
So therefore, we sell the future. We sell the put option. Then it creates a synthetical short position in a call option. So likewise, rearranging these equations, you can think synthetically what would be the put option. Put option can be created by buying a call, selling the future at this strike. If you want to synthetically create a futures, that means S, which is equal to long call, short put plus K. In other underlying assets, S is the asset. Then there's a meaning for this K. It is not here. If you go back to this equation, I have mentioned here. So we assume that the K is as a bond. The K minus 1 RT, what does it mean? This is like a bond, zero coupon bond. Paying the face value equals to K. So minus K means we are selling a bond with the face value equal to K. So then we get the present value. Plus K means, K over this means we buy a bond. So here what we can do, there will be cash flows when you buy the call and put sell the premium. Plus K, if we generalize this, this is discount or any other asset. Here part plus means C minus P, it should give you a positive cash flow. You invest that cash flow in this bond for the same period. On the maturity date, you get that proceeds and used to buy settle this transaction likewise. So that's how it works. For the time being, don't worry about other assets, but just remember on a futures, how do you do this? Simple thing, as we discussed earlier, what do you do? Buy low, sell high. So you calculate the theoretical value. That means according to the put call parity, either you calculate the put premium or the call premium, compare it with the market premiums, see whether it's which one is cheap, whether the market option is cheap or synthetic option is cheap. Whatever the cheap you buy, whatever the expensive you sell. That's what you do. In this reversal call, it says call is relatively cheap. Where? In the market. At the market, call option premium is lower than the call premium implied through this call put call parity. So therefore the market call option is cheap. You go to the market and buy the call option from the market, then synthetically create a short position on the same call. To do that, what you have to do, sell the put, sell the future, then you get a cash flow, you invest it for the remaining maturity. That's what you do. But the thing is here, we don't consider that one. Sell the put and sell the future. You get very small cash flows, but still you have to invest it to get the figures. But in futures, it doesn't matter, no need, because this factors future value. Sorry, this is the price of the future factors that time value. But if it is for any other underlying asset, that's what you have to do. But in the conversion, what do you do? Put is relatively cheap. So then what do? You buy the put now and sell the call option and buy the underlying. To buy the underlying, you need money, so you have to borrow. So that will be minus K. That's how we use put call parity. Any questions? Any questions? If you don't have any questions, okay, we move forward with this. So delta. Now these days very famous word delta. So all these are Greek letters. So therefore we call option Greeks. So we are going to, even that sigma volatility I discussed earlier, it's a Greek letter. So here time is reflected as theta, so a Greek letter. So likewise here delta is a Greek letter. So all these things we call option Greeks. What we are going to discuss here, few relationship again, option price and the underlying price and how sensitive these things. So the first thing is delta, which measures the sensitivity of the option price to the changes in underlying price of the underlying asset. So change in option price to the changes in the price of the underlying asset. So if the spot price changed by $1, what would be the change in call premium or put premium? What would be the change in call premium or put premium for a change in $1 of the asset price? That is measured by the delta. So this is the equation to calculate the delta, that sensitivity. This is like can you give me an example or some other measure that we discuss like this? It is which is equivalent to the duration in bonds. For a 1% change in interest rate, what is the change in the price? Likewise, the price of the bond. Likewise, here, for a change in price of the underlying asset, what is the change in the option premium? That ratio is called delta. So 1 unit change here, what is the change in the option premium? That is delta. So this is the interpretation. How much the value of an option will change if the price of the underlying moves up or down by $1. Clear? This is very simple. So then we need to know the characteristics of this delta for call options and put options. For call options, delta is positive. Why? What is the relationship? If spot price increases, what would happen to C? That means premium on the call option, what we discussed earlier today. If the spot price increases, what happened to the premium on the call? It is also increases. So this sensitivity is positive, moves both directions. But for a put option, if spot price increases, premium decreases. That's why delta is negative. The reason is, but for call options, delta is between 0 to 1. For put option, it is -1 to 0. 0 means spot price changes, there's no change in the call premium. Why? Can you think why? One means price of the underlying asset changed by $1, call option changes by $1. Why? When the call option is deep out of the money, that means far away from the strike, further down, spot price increased by $1 or 1 rupee, whatever the unit, will not have any impact on the premium because still there's no intrinsic value. It won't change, only the time value matters. So it is very insensitive to the spot price changes. So therefore delta is 0. But for an option which is deep in the money, that matters. For a $1 change, the call option premium also, value of the option also increases by $1. So 0 when it is out of the money, deep, 1 when it is in the money, deeply. This is also same. -1 in the money, zero when it is out of the money. When it is out of the money, the premium is insensitive for the price change. Then at the money, what would happen? For both call and put options, at the money options, delta is 0.5. It is positive for call options, negative for put options. Whenever it says delta of an option is of a call option is 0.5, you should know it is at the money. It won't say it is at the money, but just looking at delta, you should be able to say it. If it is 0.6, what do you know? Is that option in the money or out of the money? Delta of an option is plus 0.6. Is it a call option or a put option? It's a call option. 0.6. Is it in the money, at the money, or out of the money? In the money. So likewise, by looking at delta, you get to know many things. So this is an example. ABC share price 575, 625 call. What does it mean? This 625 is the strike. This is delta. Since it's a call, it's a positive delta, and the premium is 26. What does it mean? If this price increased to 576, what would be the new premium?
So premium increases?
Increases up to what?
$1.
$1. The delta is
delta 0.3.
yes. If the price of the underlying asset increases by $1, $1 or £1 or whatever, ₹1 or whatever the unit, 575 to 576, what would be the premium?
$26.3.
26.3 for a put option. So that's the question here. If the share price rises to 585, this is by $10. What are the premiums for above call and put options? So I think answer is there. Share price has risen by 10 because it's from 575 to 585. So it's not 1 unit, it's 10 units. But delta says for a 1 unit, what is the change? Then it is for 10 units, it would be 10 into 0.3. So therefore, new call premium is existing premium plus the change, 29. For the delta of the put option, remember it's minus. When the spot price increase, put option premium decrease. So by $3. So 24 minus 3, 21. Clear? But again, even though we calculated this for a $10 change, delta changes with the spot price. What is delta at when the spot price is 575? It's not the same delta when the price is at 585. Delta vary because option premium is changes. It's not linearly changed like convexity what we had. Even here that effect is there, so therefore we use this delta to calculate the premiums for a small changes in spot prices. We don't use it for large changes. So this is the again a sort of summary. For a futures, delta is +1. It gives a 1-to-1 delta. Deep in the money call, as I mentioned earlier, +1. Deep in the money put, -1. Out of the money call or put, 0. At the money call point, +0.5. At the money put, -0.5. This is the summary how delta works. This futures, this is not the underline. This is the delta of a future, not the delta of a option on futures. This is the delta of a future. What does it mean? For a 1 unit price change, what is the 1 unit change in futures? Yes, go ahead.
I was going to ask the same thing.
Yes. Okay. Even option on futures, this relationship holds. Then there's another measure called cumulative delta. That is the delta for a portfolio. Here we discuss for individual options, but in your portfolio there may be different options. Call option on call options at different strikes, put options at different strikes, and things like that. How do we calculate the delta of the total portfolio? Like we discuss duration of the total portfolio. So it will give the overall sensitivity of your portfolio and the directional bias. That means if the spot price increase, whether your value of your option portfolio increases or decreases. Directional bias means at that plus or minus. For we use plus for the long options, minus for the short options. Even a call option, if you have sold, you have a negative. What we discuss this. Okay, let me clear it. Deep in the money call. Oh, here I explained that delta of a call option is in between 0 to 1. That is plus. Again, remember, this is from the buyer's perspective. But if it is from the seller's perspective, it is -1 to 0, because when the spot price increases, premium increases, so you have, or the value of the option increases, you have already sold the option. That means you get a negative impact. So then the sign changes. That's why here we use this directional bias. For long positions we use plus, for short positions we use minus. Other than the sign at the in front of delta. So you will realize when we do a option or the example, an investor is short and at the money put is short. That means the investor has sold a put option at the money put option. What is his delta? For at the money put, delta is -0.5. That is fine. Number of positions that he has, only 1. But since he has sold it, you have to multiply that by again -1 to get that direction. So his net delta is +0.5. So that if the spot price increases, as the option seller, he get the benefit. But if the option, spot price decreases, his position value also decreases. That is what meant by the directional bias. So for example, if the spot price increased by 10, his position make a profit of 5.5 into 10. So investor B is long. Remember, this now long in the money calls with delta of 0.7. So delta is 0.7. Number of contracts 5 is long. Therefore, directional bias is +1. +1. This is just the sign we need. That's why we use +1. There cannot be +2 or +3, something like that. It is just plus sign. Number of contracts and the delta of the options. So since he has bought 5 options, 5 into 0.7, 3.5. So if the price increased by 1, he improves by 3.5. This. Okay, now we are going to calculate the delta for this portfolio. You have,
sir,
yes.
sorry. So for the cumulative delta, all those positions in the portfolio should have the same same sort of underlying and everything, is it?
Not necessarily, but then you have to think about the practical interpretation. Say you have a put option on a one asset and a call option on a one asset. We can calculate the cumulative delta. What does it mean? Then if the price of both underlying asset increased by $1 or both asset decreased by $1,
then only we can use
then only we can use that. Otherwise, there's no practical
Application, yeah.
interpretation.
Okay.
Yes. Yes.
Okay. Thank you, sir.
So this is a portfolio. You have long 10 futures, short 3 calls, long 4 puts, again short 5 puts, long 8 calls with different deltas. Definitely for futures, delta is 1. There are 3 calls with delta 0.3 plus 0.3. What does it mean? It is less than 0.5, so it is out of the money. There are 4 puts at 0.65, lower than 0.5 minus 0.5, that means in the money. There are another 5 puts, delta is 0.15 minus 0.15, higher than minus 0.5, so out of the money. Long 8 calls, delta is 0. What does it mean? Far out of the money call. So these are the comments given. Now we have to try to calculate what is the net or cumulative delta of the position. So sorry, this is just to give you a summary. To calculate it, it is used different position here. What I want, sorry, the objective of this is to explain you. Just by looking at this, you should be able to say whether it's in the money, out of the money, and things like that. Remember, whether it's short or long, it doesn't matter to say whether it's out of the money or in the money. And you can see short 3 calls, but the sign here is plus, because we forget about this short, but 3 calls, call option delta are positive, always positive. So that's why plus 0.3, but it is less than 0.5. At the money option, 0.5 delta, less than 0.5, 0 to 0.5, it's out of the money call. 0.5 to 1 in the money call. Likewise, put options, minus 1 to minus 0.5 in the money puts, minus 0.5 to 0 out of the money put. So that's reflect here. Out of the money, far or the deep out of the money call or puts, there will be delta of 0. So we are going to calculate the cumulative delta of these 4 positions. So short 4 futures, short 3 at the money calls. So what is delta here? At the money calls, we know that then delta is 0.5. What is delta here? Futures, delta is always plus 1. Deep in the money puts, what is delta? Deep in the money, what is delta? Puts, minus 1. So you cannot say deltas are not given. At the money, deep in the money, we know what is delta. So what is your cumulative delta? What you have to do, use the directional bias for each position, number of contracts, and delta. What is the delta of this position? It should be, since this is short, it's minus 1, number of contracts 4 into plus 1. What is this plus 1? It is the delta. So you get delta of minus 4 for the futures contracts. What is the delta for these 3? It will be what is the directional bias here? short. So therefore, -1, number of contracts 3, and the at the money calls. So therefore, 0.5. Net delta is -1.5. Long C, 6 deep in the money puts long. So then the directional bias is +1. How many contracts? 6. Deep in the money, -1. So it is -6. You add them together, -4, -1. Sorry, yes. -4, -1.5, 1.5, -6. That means -11.5. That is the cumulative delta. If the spot price increased by $1, your position will decrease by $11.5. Is it clear? In a delta hedge, what we do, we can use options to hedge our position. In a delta hedge, we try to keep cumulative delta at 0. That means whatever the price change of the underlying asset, there won't be any price change in your position. Your position is price insensitive. That is called delta hedge. So however, I think we should not discuss these things. We'll stop here. I just wanted to give you idea about delta in options. If time permits, we'll discuss about other option Greeks, gamma, vega, theta, and rho. But on this side, option pricing, I'm going to stop here. But remember this one: when the cumulative delta is 0, your position is price insensitive. Whether price increase or whether price decrease, your value of your position remains same, unchanged. That is page.
So page number 54, please.
54. This is the definition of the delta.
Okay, thank you.
So, this is the interpretation. How do you interpret it? So remember, or you should know all these things. So we'll take a break here. Then I'm going to switch to the other presentation, option 3, where we are going to discuss option strategies. I think it's better to discuss option strategies than the rest of this presentation. And from 15th August and onwards, again, Perry will take over the class and cover ALM, asset liability management. So before that, I want to cover interest rate. So therefore, most probably next week we'll discuss interest rate swaps. Today we'll try to finish the option strategies. So that's the plan. So we'll stop here. Oh, that means we'll take a break for about 15 minutes and start with the next presentation. But meantime, if you have any questions, you can ask. Shall we start?
Okay, sir.
So in this, we have any questions before we move?
So is this a different tute or a continuation?
This is in a separate presentation or handout. But on options.
Would you know when this was uploaded, sir?
So we cannot find out that.
Yeah, we can't find that tute.
This one?
Yeah,
Yes,
you can
sir.
see option 1 and 2.
I think with that I uploaded this.
No.
No.
And then
After
swaps
that-
and FRA.
Then
forward.
then swaps and forwards. Okay, if this is not there, then we'll what do you suggest? Still, then we can start interest
But
rate.
I mean, you can share the screen and we can look at it, so you can upload it later. That's all right.
Yeah, is it okay? But some prefer, I think, to have the printout. What do you think?
So without the printout, that's okay. We can look at the screen and understand.
Is it okay? Okay, sorry. However, I'll upload the later. Then shall we continue this one?
Yeah, sure.
Yeah. Okay. Thanks. This is about how we use options to maybe to hedge your position or to speculate based on the market. We use different strategies on using options. What we can do. So basically there are two groups of strategies. One is called option spreads, other one is option combinations. So there are different type of spreads and different types of combinations. The difference between spread and combination: in a spread we may have more than one option transaction, but all those are either of call options or put options. We don't combine them together. Collection of call options or collection of put options. But in the combinations, it's a collection of or the mix of call and puts. That's the difference. So as it said, spreads, simultaneous purchase and sale of option in the same class. What does it mean by same class? Either put or either put options or call options. We don't combine them together. That's the spread. In the combination, it will be a combination of put plus call. This is the combination. In the spreads, either collection of puts or collection of calls. Again, within spreads, three different types. So we are going to discuss three different types here, basically: vertical spread, horizontal spread, and diagonal spread. I'll explain what is vertical, what is horizontal, what is diagonal. In a vertical spread, it is we buy or sell buy and sell options with different strikes but the same expiry. We buy a call option, we sell a call option on the same underline but with different strikes with the same expiry. That is vertical spread. Then in the horizontal spread, it will be with different expiries. So we'll discuss that later. For the time being, remember what does it mean by vertical spread? Different strikes but the same expiry. When it says spread, it can be a collection of calls or a collection of puts, not a mix of calls and puts. So again, there are two basic types: vertical spreads, bull spreads and bear spreads. So bull spreads work when the market goes up, when you anticipate uptrend. Bear spreads when you anticipate a downtrend. So what is a bull spread? Vertical spread. What is a bull spread? You buy a option with a lower strike and sell an option with a higher strike. So this is X1, this is X2. Two different strike prices. You buy this one and you sell the option with a high option or a put option. Irrespective of whether it's a call or put, you buy the lower strike, you sell the higher strike. That's what you do. That can be a put option. This can be a this should be a put option. Both are put options. You buy the lower strike and sell the higher strike. That's what the strategy. That's the strategy basically. Bull spread. Then again, it can be a bull call spread or a bull put spread. This is an example. Buying the 500 call, selling the 600 call. 500 means the strike price, lower strike price. 600 is the higher strike price. The same thing can be done on the put. Still you buy the lower strike put and sell the higher strike put. Now let's see what's the bear spread. Bear spread, you do the opposite. Here you sell the lower strike and buy the higher strike. So X1, X2. Previously this one, if I do it like this, bull, bear. What do you do? Bull, you buy this. Sorry. What do you do in a bull spread? Which one you buy? You buy the lower strike and sell the higher strike. In a bear spread, what do you do? You sell the lower strike and buy the higher strike. That's what you do. Again, these two examples, bear call spread and bear put spread. In a bear call spread, you buy a call option with a higher strike and sell a call option with a lower strike. So selling the 500 lower strike option call while buying the 600, that means higher strike call option. In a bear put spread, you sell the lower strike put option and buy the high strike put option. Is it clear? Is it difficult? This is something sort of to remember, because this is the sort of definition. What is a bear spread? What is a bull spread? In a bull spread, You buy the lower strike and sell the higher strike. In a bear spread, you sell the lower strike and buy the high strike. In a vertical spread, so we try to make a profit with the directional movement in the underlying asset, whether prices going up or whether prices going down. But the difference is, if you just buy a call, what do you think? You assume the price will go up without any, you don't have any limit there. But when you buy a bull spread, you assume price will go up, but moderately. It may not be a drastic upward movement. It will go up, but up to a certain limit. You have a target. The price may not move beyond this point, something like that. If assume that the today's spot price is 80, you think it can go above 100, but it may not go above 150, something like that. There's a possibility that the price will remain somewhere here. So in such scenario, you buy a bull spread. Why? If you buy only this option, what would happen? You buy a sort of lower strike call option. If you buy a call at this point, you buy a call option with a lower strike comparatively, and or which is close to the current spot price. Your expectation is price will move up. So to buy this call, you have to pay a premium. But if you think the price will not move beyond that, your limit is limited somewhere in between this. Your gain is limited. Sorry, your gain is limited somewhere here. So if you can have some guess or calculated guess that price won't move beyond 150, what do? You can reduce your cost, this premium, by selling this call. When you selling this, you collect the premium. This is a plus premium, this is a minus premium. You pay this, here you receive this. So your cost will be less. Clear? What is the intention of buying a bull spread? You think price will go up beyond a certain level, but it may not move beyond another level at a high price. So you assume the price will remain in a band. So you buy the lower level call option and sell the high level call option to reduce your cost and maximize your profit. That's the basic idea behind buying a option spread using call. So therefore, these are moderately bullish or bearish strategies. The bearish strategies comes when it goes other way around. If you think price will go down, but only up to a certain level, it will go down below this, but it will not go down below this. So price will remain somewhere here at the expiry. So what do? That is the idea behind this trading on spreads. Either moderate bullish view or moderate bearish strategies. So downside losses are known, because once you buy or sell options, you know what is the downside risk. For example, assume the current price of ABC PL's company is 550. So this is spot, and the option available with the quoted premium at a range of exercise price calls are follows. So call prices given, strike prices given, put prices given. So for a 500 strike, call price is 70, call premium is 70, put premium is 80. Likewise. So assume investor is moderately bullish on ABC shares and thinks the shares will rise beyond 550. Investor thinks the price will go up beyond 550, but not beyond 590. So basically 550, 590. The investor expects price to be remain somewhere here on a future date. So what he would do, what is the current price? 550. He can buy a call at 550 and sell a call at 590. So therefore he could buy a 550 call and pay a premium of 37. How do you get that premium? 550 premium is for a call option 37. He has to pay it because he is going to buy that 550. Maybe sell the option at 600 and receive in 90. Pays the call at the same time and receive 19. So what is the net payment? Is only 18. The investor reduces his cost because he knows the maximum gain that he can get be in between somewhere here 550 to 600, because the investors of the view that price will not go beyond 590. So what are the outcomes, possible outcomes? In the scenario 1, if the price remains at 550 or below, so I'll draw this again. This is 550. This is 600. Scenario 1, if the price remains at 550 or below, that means on the expiry date, price remains here or below that. What do you do? On the expiry date, spot price is less than or equal to 550. What do you do? If the spot price remains 550 or less than that, what do you do? You have bought a call here. Buy a call here, sell a call here. What do you do?
There's no need to exercise this call because the price is, the spot is same as the exercise, right?
Same or less than that. So you won't exercise your right.
And then obviously the person who's buying the call will not exercise as well.
Yes, he is also not going to exercise. So what is your gain or loss?
It's the difference between the premiums.
So premiums, it is the net outlay of 18. That means you lost 18. Clear? Now the scenario 2 is when the price is in between 550 and 600. What do you do? the price remains somewhere here, $550, spot price is more than $550 but less than 600. What do you do?
We exercise, sir.
You exercise your right because you have a call option.
By
You bought at 550. You bought the call option at 550. Now the price is higher than that. You exercise your right. But what would happen to the call option that you have sold? The buyer of that option still he will not exercise his right because still he can buy at the market at a lower price. So whatever the difference between 550 and spot price, you will get it as the gain minus 18 is your outflow. Correct? Is it clear? Then the third scenario, it would be when the price is above 600. What would happen? When the price is above 600?
Both can be exercised.
Yes, you will exercise your right. The buyer of the option will exercise his right. So what is your maximum gain there? Then? You will receive whatever the difference between spot and 550. But you have to pay the difference between S and 600. Effectively, you get this whole difference, 50 rupees minus your 18 premium cost. So if you put that into a diagram, so this is scenario 2, what I have explained. Outcome scenario 3. If you put that into a diagram, this would be the diagram. So until 550 price comes to 550, neither you nor the buyer will exercise options. But after 550, you will start to exercise the option, but not the buyer of the option at 600. So your profit will start to increase at 568. That means 550 plus that 18, you get the break-even point. Beyond that, you will increase your profit until the price reaches 600. Because in between 550 and 600, you will, as a buyer of a call option at 550, you will exercise your right, but not the buyer of the option at 600. He will not exercise his right. But the moment the price moves beyond 600, both will exercise your rights. Then, as a buyer of 550 call and the seller of 600 call, you will get the difference between 600 and 550, which is 50, but you have a net outlay of 18. So therefore, profit is 32. Maximum profit is 32. So whatever the price moves here, your maximum profit would be 32. If it remains below 550, your maximum loss is 80. This is how bull call spread payoff or the diagram or sorry, profit diagram would like to be. Is it clear? So for you to understand this, you should be clear about when to exercise your rights as option buyer and what are the obligations that you will face as an option seller. So basically this diagram is a combination of two diagrams. As an option buyer, you would see something like this. This is 550, correct? As option buyer. Then as option seller at 600, what do you get? You get a premium up to this 600, then you lose. So I'll delete this part. You receive premium up to this 600, then you lose. This is 600. This is 550. The big picture shows the net impact of these two, correct?
So you can avert that loss with the shares you received, right? They are with the 550 exercise.
It's not. No, it's not that avert your losses, because if you don't sell this 600 call, your payoff would be something like that. If the price increases beyond 600, still you get it. If you buy the call option at 550.
Okay, so you essentially limit your gain.
Why? Why you limit that? Your view is the chances of going beyond this is say 5%, according to your calculation. Remain here maybe 80%. The rest 15% may be here, or maybe 5% here, 15% here, or whatever. So more chances to be remain between 550 and 600. If you just buy a call, even though you keep open the high side, if it is only to be realized $50 at the maximum, you have to pay 37 premium. But by doing this, what did you do? You reduce your cost to 80. Even the price goes down, you reduce your cost. Even the price goes up and remains here, your profit increases. Otherwise, even it goes to 600, you don't get positive premium or positive profit. If you just buy this 550 call option, what is this break even point?
Should be 582.
587. Because 37 is the premium for 550.
Yeah.
You have to pay 37. So you have to wait until 587 to make a profit. But now, after 568, you make a
You're making a profit, yeah.
But, and the high chances is it won't go beyond this. So, buyer of the call option at 600 will not exercise, but you will exercise your option, but at a lower cost. That is the idea or the intuition behind this. Is it clear?
Yeah, yes.
Okay, now think about, okay, this is the summary. Motivation, moderately bullish. That means as a buyer, so we call it buying a bull spread. What does it mean by buying a bull spread? You buy a lower strike option and sell the high strike option. That means as a spread, you buy that. But it has one buy transaction and one sell transaction. Okay. So basically, maybe there may be another counterparty which gives you this bull spread at a premium of 18. That's it. As a package, whole package. Or you can do this with two different counterparties, two different trades. So however, altogether we call it as a buying a bull spread. So VV is moderately bullish. That means we assume price will go up, but not by a large amount. There will be a limit. So how to construct it? Buy a lower strike and sell the higher strike. Net premium definitely will be a paid out. Why? That is something that we could not discuss. Even when I draw this, you can see this gap is higher than this gap. Why is that? The two premiums. You buy the premium with a lower strike call option. Lower strike call has a higher premium. So you have to pay a high premium here. But when you sell a call option at a higher price, higher strike, you will collect a small premium. That is reflected even in this table. When the strike price increases, you can see call price or the call premiums decreases. To buy at 550, you have to pay 37. To sell at 600, you receive only 19. So since always you buy low, buy a option with low strike and sell option with high strike of call, the net premium is negative for you. That means you pay the premium. Clear? So all those things what we discussed so far, we put them together. That's what we are doing here. Any questions? So the maximum risk is again the net premium paid, whatever the paid out here. Maximum reward is the difference in strike less the net premium. You don't get anything beyond that. Break-even point is lower strike plus the net premium. This is the summary of the bull call spread. Once you do this, you know what is your outcome. Risk and return, everything you know. So what would be the bull put spreads? Same thing. Try to understand the payoffs for a bull spread. Still remember, you buy the lower strike and sell the higher strike. Okay, before we move, we'll do this and try to answer this question. Mr. Z buys a 500 put in ABC PLC shares for 18 pence and sells a 550 put at 35. What is the outcome at expiry if the price of ABC PLC shares is 490, 530 and 575? Okay, tell me. What he has done, buy a put at 500, sell a put at 550. What would be the outcome if the price is 490? That means price is somewhere here, 490. Before we go to that one, again, check at the premiums. To buy this, he pays only 18. But he sells this at 35. Why? For put options, higher the strike, higher the premium. Lower the strike, lower the premium. So at this instance, he buys the option at a lower cost and sell the option at a higher price because the option he sold at has a higher strike. So what is net gain or net receipt or a payment? Is it a net receipt of options or net payment of options?
There's a net receipt, right? Because he
Net receipt, because he sells at 35 and buys at 18. It is plus 17. He received the net premium. Okay. With that mind, try to answer this. If the ABC price is at 490 on expiry, what is the outcome? Will you exercise your right?
No.
Yes or no?
No.
No. Why?
Less than 500.
What is less than 500? Market price is less than 500. What is the option that you bought?
500.
Huh? You bought an option with a strike of 500, but what type of options that you bought?
Put option.
Put option. So in a put option, when the strike is 500 and the market price is 490, spot price is 490, what do? You are a buyer of a put option.
So you sell the
You sell the asset at what price?
500.
At
The
500.
exercise.
That means you exercise your right.
Right.
You exercise your right. In this case, yes, sorry, yes. When you exercise your right, when you exercise your right, what is the inflow here? This difference you gain plus 10. But what would happen to this one?
You have to pay a premium of 18.
it will also get exercised, right?
The buyer of the option at 550 will come and exercise his right. Then you have to pay the difference. What is the amount that you have to pay?
That is 8. No?
Oh, it's 60, right?
550 minus 490. You have to pay 60. What is the total? What is the net cash flow, including this premium?
There's a negative 13, right?
Negative
Sorry,
33.
33. 60.
Minus 50 plus 17 minus 33. Negative 33.
30. Yeah.
Okay, assume this is 470. What would happen?
It's negative 53. Still
Negative?
both, yeah. 53, right? Because both of them get exercised, right?
Both of them get excised. So what is the outcome?
So that 20 difference will also go out from your pocket, right? Because
Is that so?
all right, so you can sell it at 500.
Still 33, sir.
Still minus 33. Yes. Why? So whatever the difference between 500 and 470, you receive it. Because you have bought a put option at 500. You exercise your right, you get that 30. So instead of this plus 10, you get plus 30 here. But you pay
80. Yeah.
80. So whatever the difference would be, 50. This difference remains unchanged. That's your net outflow here without the premium. So minus 50 plus 17, it will be minus 33. So beyond or below 500, whatever price, your downside would be minus 33. Now consider this second option. When the price is at 530. That means somewhere here. What would happen? What's the outcome? Will you exercise your right?
No, right?
No. Why?
Because it's lower than the market price.
Your strike price is lower than the market price, so you don't want to sell at that lower price. You can sell it at the
Market price.
So what is the flow, cash flow there? This plus 17 is there, the premium, then 0. You don't exercise your right. Then what else?
The buyer would exercise.
But the buyer of the option at 550 will exercise his right. Then what is the outflow?
£0.20.
Minus
Yeah.
20, 550 and 530. So still you lose 3. That's the outcome. Okay. What if it is 510? Sorry, 540. Instead of 530, price is 540. Still you don't exercise your right, correct?
Yeah.
0. But now what's the payout? It's only
10.
minus 10. Now what is your outcome? It is plus 7. Okay. At this point, what's the outcome? If the price at the expiry is 575 pence. Will you exercise your right? when the price at the expiry is 575, will you exercise your right? Yes or no?
No, sir.
No. Why? The
That
market price
570
is higher than the
higher.
strike
The
price.
strike price.
What happened? What would be the action of the option buyer at 550? Will that buyer exercise his right? Will he exercise his right? No. Why? Again, the market price is higher than the strike price. He won't sell it at lower price when he has the ability to sell it at a higher price. Okay, then what are the cash flows? At the beginning you receive this plus 17. Then on your the option that you have bought, there's no cash flow, no payoff. On the option that you have sold, again there's no, so the profit would be 70. Correct? What would happen if the price goes to 600? What is the outcome if the price goes to 600?
17.
Still no cash flows or the no payoff from both options, just the premium collected. So it will 17. So what would be the shape of the payoff diagram? It would be same as the what we had for a bull call spread. So you can see here below 550 it was minus 33. So after 550 it start to increase, but after after 500 it starts to increase. After 550 it goes flat, minus 33 here, plus 17 here. That's the profit diagram of this bull put spread, but the shape is same as the bull call spread. So that's why both are bull spreads. So just to explain what we discussed so far, net premium plus 17 at first instance when the price is 490, both options will be exercised. So you pay 60 pence, you receive 10 pence because you exercise your right as well. So the loss of 50 pence is the ultimate. Net loss is 33 pence. So remember, it's a net loss. Earlier we get it as net minus 33. That means net loss. In the second scenario, when the price remains between 500 and 550, still the net premium is 17. 550 put will be exercised. This put will be exercised, but this one will expire without exercise. So you pay 20 pence. So the net loss is 30 pence. In the third scenario, when the price is above 550, in this example 575, neither options will be exercised, but no cash flow. So the net gain is 17 pence. So the payoff diagram will be like this. This is the payoff or the profit diagram of the bull put spread. When we compare the shape, it is the same shape as the bull call spread. There's no difference. The shape is the same, but this slope and these figures may change depending on the prices. So this is the motivation and the summary. Still the motivation is moderately bullish. What you think? You think price will not go up slightly drastically, or may not go down drastically. In between that, you can make the profit. So then we'll move into any questions. Now I'm going to move into the bear spreads. Any questions? So if you don't have any questions, we'll go through the bear spread. This is the opposite of the bull spread. Here, what do? Buy the high strike one and sell the lower strike price. When do you do that? When you are moderately bearish. That means you think prices will go down, but not by a large amount. Then you do this spread. So again, same thing, but this time you sell the lower strike and buy the high strike. The net premium is this time plus 18. Earlier it was minus 18. So scenarios, the same scenarios what we had. Scenario 1, if the price remains at 550 or below, what do you do? We have 600 here and 550 here. You have sold the call option here and bought the call option here. When the price is $550, what would happen? Price at 550, what do you do? Will you exercise your option?
So this is a called the sold option, right?
Sorry?
This is called the sold option, no?
What does it mean?
Sold the call option, no, sir?
Yes. You sold this one, you bought this one.
Okay, not exercising, say that way 550.
You sold the lower strike and bought the higher strike. When the price is 550
Not exercising.
or less than that, will the buyer of the option will exercise? Will
No,
the
sir.
buyer exercise? No. So it will expire. What is your gain? You just collect the
Premium.
80. So nothing would happen. In between this, somewhere here, 575.
So it will get exercised.
Which one?
The sold.
This old one. This one will be exercised. So you have to pay the difference minus 25, and what you collected is 18. So it will be a minus 7. What would happen when it goes here?
Both of them will get exercised.
Both will be exercised, and what is your gain? Indeed, whatever the difference between 550 and 600 you have to pay, you will get, sorry, in between 550 to this one you have to pay, but you get this one. So it's a net payment up to this. Is it clear? Minus or the plus 18. That would be your outcome. So in this scenario, payoff would be you will get a premium collected, then it will go down and remains. This would be the profit diagram for a bear call spread. Is it clear? So this is not shouldn't be a difficult task, because you know what does it mean by a buying a call option and selling a call option. When to exercise your right, or when would be the buyer of the call option will exercise, or the buyer of a put option exercise his right. You know that. So just combine that for two different options. So then what do you, this is the summary. Moderately bearish, motivation is moderately bearish. That means if you think price of the underlying will go down but by a small amount, then you do this. You don't expect large drops. If you just expect large drops, what do? You just buy the call option. That's it. Sorry, if you expect a large drop, what do you buy? I think I said you buy the call option. No, what do you buy if you expect prices to go down drastically?
A put option.
You buy the put option. Yes. So luckily I realized that I used the wrong word. Yes, you buy the put option, but you expect a moderate price drop. So therefore, while you are buying a call option, you sold a call option as well. But the next one, you buy a put and you sell a put in a bear put spread. So this is the summary in a bear put spread still moderately bearish, you sell the lower strike put and buy the higher strike. So if you buy a put option on a higher strike, your premium is high. So therefore, the net premium is paid out. So the maximum risk is that amount. Difference in strikes is the and the net premium paid is the maximum reward, and the break even is the higher strike less the net premium paid. So this is the break even, higher strike minus the net premium paid. Sorry, not in that. This is this figure comes in call spreads. No, this is put spreads. So this is the example. I think you can work out this now to get these figures. Net outlay is 32. Fine. Then 600 minus 32, 568, 550. Below 550, he collects 18. Up to 550, he get a positive, but declining after 560, it's negative. Beyond 600 is always 32. But you can see the outflow is, the loss is higher than the possible gain. But what's the risk here, or what is your expected cash flow is positive, you think, because you think the most probable case is this part. You expect this to happen with a low probability or low likelihood. That's why you take this call. Any question? Is it clear so far? Spreads, option spreads. Option spread is a simultaneous purchase and sale of options in the same category. What does it mean by same category? Either call options or put options, buy and sell both. But then we have vertical spreads, horizontal spreads, and diagonal spreads. The two strategies we discuss are vertical spreads. That means different strike but the same expiry. Those are the vertical spreads. We buy an option and we sell the option with different strike but with the same expiry. Those are the vertical spreads. Vertical spreads, again, we can divide into two: bear spreads and bull spread. In a bull spread, what do? We buy the lower strike option and sell the high strike option. In a bear spread, we sell the lower strike option and buy the high strike option. That's what we do. Then the payoff in a in a bull spread, payoff for the profit diagram would be like this. In a bear, it would be like this. So that's the summary. So next one is the horizontal spread, or we call them as calendar spread as well, because we get the spread due to different expiry months. We don't use the same expiry in this case, but same strike with different expiries. When we do this is when we have expectation on the moves of or the changes in volatility. When we expect changes in volatility, we do this horizontal or the calendar spreads. So basically motive is you assume that the volatility will go down. What would happen if the volatility goes down? What would happen to the option premium if volatility goes down? Premium goes down. Okay. Now, but we use two different expiries. Then what is the impact on that? So volatility goes down, premium goes down. In which one would you expect the prices to fall drastically? Long dated one or the short dated one? It is the short dated one because of the erosion of time value. Can you remember? We discuss when it short maturity or the when it get closer to the maturity, price drop drastically. So for the same volatility change, price would drop drastically in the short maturity option. So therefore the strategy is sell in a shorter maturity and buy in a longer maturity. That's what we. If you think volatility will fall. So this is an example. Sterling dollar spot rate is currently quoted at this rate. Foreign rates are currently quoted in the market. So for different prices, different maturities, what are the call premiums, what are the put premiums. Still you can see when the expiration increases, premium increases, either one, whether it's a call or put, irrespective of that, prices, premiums increases. What we think, price will remain almost the same level. So an investor will sell the 1 month 5825 put, sell the put, premium is 50, buy the 6 month 15550 put, to 95 for a net cost of 240. So that means volatility, what he expect volatility to be low. That's why he is expect remain steady. So he just did the opposite of what we discussed here. Sorry, did the same thing what we discussed here. In the next example, if the volatility rise, what would happen? Volatility rise, premium what would happen to the premium if the volatility increases? Premium increases. So it's a positive relationship irrespective of whether it's a put or a call. Now, if volatility increases, premium increases. Now we are discussing about two different maturities or the expiries, of which whether the shorter maturity or the longer maturity price would go up drastically than the other one, relatively. still the short term one will move fast. That's what happened. So that's why selling a longer maturity and buying a shorter maturity. So when you buy the shorter maturity and price increase drastically, long maturity price increase by a small amount, that difference would be positive for you. That is the strategy in horizontal spread. So horizontal spread, again remember here I haven't mentioned whether it's a put or a call. Whatever, you can buy a shorter maturity call and sell a longer maturity call, or buy a shorter maturity put and sell a longer maturity put. That's the only thing. You have to buy the same type of or the same category options, either call or either put, not a mix, but with two different maturities with the same strike. With that, remember that one as well. It should be with the same strike. That is horizontal spread. So basically horizontal spread, we buy sell same category options with same strike but with different expiry date. If you expect volatility to be low than the current, then what do? You sell a shorter maturity and buy a longer maturity. But if you think volatility to increase, you buy a shorter maturity and sell a longer maturity. In the diagonal spreads, we combine both vertical and horizontal spreads. That's what you do. Buying and selling options with different strikes and different expiry months. To get the both volatility and advantage of both the volatility and price movements depending on your view. So yeah, I'm not going to discuss too much on the diagonal, but basically motives of it's a combination of vertical spreads and the horizontal spread. So the combination of motives would work there. So if we move into combinations, as I mentioned earlier, in a combination, it's a put plus a call. In spreads, it's only either call plus call or a put plus put. Indeed, one long and one short, one long and one short. In combinations, put and call, it can be again purchase or sale of calls and puts. Again, there are two main strategies: straddles and strangles. What is a straddle? Okay, so before I go into straddles, when do you do this? Again, these both combinations, straddles and strangles, we use to to make a profit from the change in volatility. You go long any of these straddles or strangles when you expect volatility will go up, but you you go short any of these combinations when you expect volatility to decrease. We'll see why this happens. So this is an basically I'll tell you what do you do here. In a straddles, you select a strike, you buy a put and call with the same strike. You buy a put and call with the same strike. Then what would happen? To buy the option, you have to pay a premium. So below the strike price on the call option, it will be a loss. Then it will go up like that. Correct? This is just the payoff of the long call. Then you have a long put as well. You buy a, sorry. You have a long put. What is the payoff diagram for a long put? You lose the premium if the price is above the strike, and if the price is below the strike, you make a profit. This is the two payoff diagrams or the profit diagrams for a long put and a long call. So this is the strategy. You buy a put and you buy a call with the same strike. So you get these two payoff. So the net would be something like this. Oh, this should be parallel to B. So it should be V-shape, the profit. So either price goes down, you make a profit, or price goes up to make a profit. That's what would happen in a straddles. In a strangle, what would happen? Instead of a single strike, you select two different strikes. So you buy the call here, you buy the put here, and you buy the call here. Then payoffs would be something like this, and something like this. Then the net impact would be up to this one. This is the shape. So in these option combinations, remember what do? You buy a put and call either with same strike or with two different strike. Straddles, this is same strike. But here, two different strikes. With the lower strike, you buy put. With the higher strike, you buy the call. X1 is less than X2. That's what you do. That's the basic idea, because if the volatility is high, you don't know which way the price would move. It can be up or down, but you don't know the direction, but you know the price is going to move away from the current price. So you do this strategy. Either way, you will make a profit, but only thing is to buy the option, you have to, because you are buying a call and a put, you have to pay 2 premiums. So your premium cost would be high. That is what happens in a long straddle. Buy the call and buy the put with the same strike, same expiry. So rationale is as an investor, you are unsure about the direction, but you know the price is going to deviate from the current price either way, either up or down. So this is again example. You buy 550 at paying 37, you buy 550 put at 35. So the net outlay is 72 because you are going to make a profit either way the market moves. So it's not, you won't get it at a low cost. You have to pay the high price to get that. So which gives you a profit when the price moves either way. So as I explained, this is the payoff for the call option. This is the payoff of the put. So what we are going to do, combine these two together. So basically remember the relationship. The option of the call option is high than the premium of the call option is higher than the premium of the put option. I think when I draw this I couldn't, I did other way around. But it should be call premium should be higher than the put option premium. So these are the two payoff diagrams. When you net it, this is the net diagram. You get 2 break-even points, less than the strike and the higher than the strike, but by the same net outlay. 550 minus 72 and 550 plus 72. So this strategy is very costly because you have to pay high premium, costly, but either way market moves, you make a profit. The Strangle is the same version, but with the intention to reduce the cost. So whenever you reduce the cost, your gain also reduces. So in the long straddle, expectation of increasing volatility. So you buy a call and a put with the same strike and same expiry. So that's what we discussed. So the maximum risk is whatever the premiums that you paid. Maximum reward unlimited theoretically. This way it will be limited up to the break-even limit. But this way, if price goes up, there's no limit. So theoretically, unlimited profit. There are 2 break-even points, as I mentioned earlier. This is an example, long straddle. What is the break-even range for the buyer of a put and a call on XYZ PLC shares, where the 500p calls has been purchased for 18 pence and the 500p put has been purchased 7. What are the 2 break-even points? What is the total cost, total premium? What are the total premiums here? 18 plus 7, 25. So this is the strike. 500 plus 25, 525 minus 25, it would be 475. So these are the break-even points. In a short straddle, that means you do the other way around. You assume volatility would remain low or go lower than the current expected or the implied volatility in the market. Then what do you do? Instead of buying a call and a put with the same strike with same expiry, you sell the call and the put with same strike and same expiry, then your payoff diagram would be the opposite of the previous one. Why do this? Again, the price will not move too far away from the current price. That is your intention. So sell both call and put to collect the premium. But if it moves away, this is the strike, you can collect the premium maximum. If it moves away, you lose either side. So it is the mirror image of the long strategy. So you assume most of the time prices to remain in between these and collect this whatever profit. That is your expectation. But this is a highly risky strategy. But if volatility increases, you would never know what would be your loss, unlimited loss. So this is with the numbers. So you can see loss increases either way. In between the two break-even points, you get this, but it is up to the maximum profit would be the premiums collected. Risk unlimited, maximum reward limited to the sum of the premiums received. Then the long strangle, as I mentioned, you buy the call and the put, but with different strikes. Usually call strike is greater than the put strike. You may remember I draw that line, x1, x2, and I say you buy put here and you buy call here. Then the payoff diagram, profit diagram would be something like this. Sorry, not at this point. Yes. These are break-even points. But still the same expiry. In this, your total cost would be less because you buy a out of the money put and out of the money call away from the market. Then the premium would be less. But to do this, you should expect a large volatility. If the current market is somewhere here, you should expect price to go further down or further up. Then only you make a profit unless you make a loss there. So this explains that. So even in this case, it's a premium outlay, but it's a low figure than for a straddle what we discussed earlier. But for it to be success, volatility need to be very high. So the maximum loss will be crystallized over a range. So maximum loss will be fixed or freeze at or due for a range, longer range than in the straddle. So this is an example. Then the two break-even points are the lower strike minus net premium and the higher strike plus the net premium. So it will be, or the distance between break-even points would be much high. But if you, as you expect, if the volatility is too high, the chances of making profit is high, and it is unlimited again. So maximum risk limited to the sum of the premiums paid, which is lower than the premium paid in a straddle. There are again two break-even points: lower strike less total premium, higher strike plus total premium, as I explained here. Again, what are the break-even ranges, or what is the break-even range for the buyer of both the 400 put and the 450 call? So break-even points, what is the total premium? 17 plus 8. So total premium would be 25. Then the break-even points would be 400 here, 450 here. 450 plus 25, 475. 400 minus 25, 375. So these are the break-even points during which you make a loss. So in a short strangle, you do the opposite. Instead of buying the call and the put, you sell the call and the put, again with two different strikes, generally with the higher strike for the call and the lower strike for the put. Then again the payoff would be opposite of the long strike. In between two strikes, you make money equal to the premiums collected. Up to break-even points, your gain will be reduced. Then after break-even points, then it will become a loss, an unlimited loss. Again, but the premium received is lower than for a straddle. So this is an example of a short strangle. This is the shape of the combination. So you do this when you expect a large decrease in volatility. But if your view goes wrong, you will incur a huge loss. So that's all I wanted to discuss on this option strategies. Any questions? So I went through relatively quickly because I explained the first one for the what is a straddle. The same concept is used in the strangle as well. Only difference is two different strike prices, and you know what does it mean by a long put, what does it mean by a long call. You know how to draw the profit diagrams. Then the matter comes, how do you combine two profit diagrams? Any questions? Any questions?
So when can we have this YouTube?
I'll upload now.
Hello, excuse me.
I'll upload it now.
Sorry, sir. Sorry.
I'll upload it now. Just after the class.
Okay, thank you, sir. Okay, thank you.
Sorry about it. I was of the view that I uploaded it. That's what I remember. So, any other questions? We'll discuss interest rate swaps next week, and if time permits, we'll discuss forward rate agreements as well. If not, we'll discuss that after you finish ALM, asset liability management part. However, after that, we are going to okay. Remember, during asset liability management, you may use the concept duration and convexity. So remember to revise that before you go or you attend the classes in ALM. So you should be able to interpret what is duration and how do you use that duration. You should be thorough on that. So please get ready for that. Otherwise, then you will find it difficult. ALM, some of the, not all ALM, but some of things. And once we finish this and the ALM, we are going to discuss about risk management, in which again we will use that interest to manage the interest rate risk, duration, and to manage other risk, interest rate, FX, or commodity price, or whatever market risk. Generally, we will use these futures, forwards, and options as well. So you will see some applications of these products in risk management. So therefore, as I mentioned at the very beginning, all these are interconnected. So remember all those things when it comes to those classes. Anything? If you don't have anything, we'll stop here. Or if you need any more clarifications on what we discussed today, you can ask any question. And there's another, maybe a good news for you. I hope it went all okay, because the exam for the previous batch was held today in now currently going on, hopefully without any problem. If it happened or successful, then we can distribute that paper among you. Then you can refer that paper. But if the exam goes without any problem today, I'll ask them to upload the paper today. Any other question?
Thank you, sir.
Anything else? If you don't have any questions, we'll stop here.
Thank you, sir.
Okay, thanks.